Hello. Today we would like to talk about the historic leveraged buyout of Hilton Hotels Corporation by the Blackstone Group. To do this, our group has created an analysis of the LBO, which includes a brief description of Hilton Hotels and the Blackstone Group. A time Hilton Hotels, better known as Hilton Worldwide Holdings, is a multinational hospitality company which spans across 17 different brands. Hilton Worldwide Holdings generates revenue through four main segments: owned hotels, leased hotels, franchise fees, and timeshare fees. Between 2004 and 2006, revenue for Hilton Hotels soared with an 84% growth in 2006. During the acquisition time period, Hilton contained 2,935 properties with 501,000 rooms in over 78 countries and territories, making Hilton one of the largest hospitality groups in the world. Hilton Hotels' humble beginnings began in Waco, Texas, when in 1919 Sir Conrad Hilton founded the company, opening his first hotel by 1925, which was in fact named after himself. A considerable amount of time later, in 1946, Hilton had its first initial public offering, made for an undisclosed amount. In 2005, another major milestone was the reacquisition of Hilton's international chain, which had operated as a separate company since 1964. Finally, in 2007, interest for a potential buyout began to build. This leads us to a description of the interest of the Blackstone Group in a buyout of Hilton Hotels.
A little history on Blackstone. The firm was founded by Peter and Stephen Schwartzman in 1985. The firm became known for its success globally, a quote world leader in alternate asset management, one of the most profitable being real estate. With a history of investing in the hospitality arena, it was no shock when the number of hotel rooms owned by Blackstone increased to 615,000 around the world by the end of 2007. Blackstone had always prided themselves on having the best people in the business, which led them to being one of the top advisory firms as well. The firm's portfolio has always been diversified, and their track record has shown they can be successful in all types of market conditions. The firm was the first of its kind to go public around the same time the Hilton deal was getting done. In 2006, Blackstone's CEO reached out to Hilton about the acquisition and taking the company private. They disagreed on price until July 2007, when an agreement was made for Blackstone to take Hilton private at a 40% premium. Later that year, the acquisition was completed, while at the same time the U.S. housing market was starting to collapse. The greater global economy started to suffer in 2008, and the hotel industry was taking a big hit. Bear Stearns was one of the companies involved in the acquisition of Hilton, and they were absorbed by J.P. Morgan. Blackstone also completed the first of two debt refinancings in April of 2010, and just after they invested an additional $819 million into Hilton. Towards the end of 2010, Hilton settled a large lawsuit with one of their top competitors, Starwood. The second debt refinancing was completed in 2013, just before the Hilton company was set to go public again.
Hilton Hotel was positioned within the lodging and hospitality market. It was a mature industry that was highly fragmented, as Marriott, the largest player in the space, controlled 0.6% of the market share. Hilton was the second largest player in terms of market share, controlling 0.5%. It's a cyclical industry that's heavily dependent on seasonal cash flows. The total revenue generated the year before the LBO was $156 billion, a 35% growth rate from 2001. It was expected to grow at a 2% CAGR throughout the next 5 years, and however, profitability was expected to decrease as overall competition within the space increased, squeezing margins for the businesses. Companies expected large growth potential in international expansion, specifically in the Southeast Asian area. Hilton, in order to realize some of those growth opportunities, invested and reacquired Hilton International chain.
In order for this acquisition to make sense, both Hilton and Blackstone needed to have reasons for being involved in the deal. Hilton Hotels had a history of financing their growth with high levels of debt. However, they needed access to this debt financing in ways that they could not provide on their own. This forced them to look externally in order to raise the necessary capital for their future international expansions. Blackstone offered a high level of expertise when it came to the real estate and lodging industry, as it already owned more than 100,000 hotel rooms across the globe and had experience in managing the hospitality business. Because of this, Hilton would be able to capitalize on this experience to stimulate their future growth. In addition, this extra financing would help increase the total number of rooms available in Hilton Hotels and would help create additional brands for the company. From Blackstone's perspective, Hilton Hotels was appealing due to their strong brand image, which could drive down sales and marketing costs. Blackstone was looking to expand their real estate and lodging exposure and would benefit from synergies associated with their existing portfolio. Blackstone knew that this investment was a risky play, but the high leverage with favorable terms and structure made the deal a very attractive prospect and could potentially provide lucrative returns down the road.
There were 7 bank sponsors that assisted Blackstone with this transaction, including Bank of America, Bear Stearns, Deutsche Bank, Goldman Sachs, Lehman Brothers, Merrill Lynch, and Morgan Stanley, all of which acted as financial advisors to Blackstone and each offered debt to assist in the deal. In addition to Blackstone's sponsors, Hilton Hotels received advisory services from UBS Bank and Moelis & Company. The conglomeration of Blackstone's debt sponsors totaled $20.5 billion, or about 78% of the transaction, while the equity portion that Blackstone injected was worth $5.7 billion, or about 22% of the transaction. Blackstone carried out one of the largest private equity deals in 2007 at a total of $26.2 billion. Blackstone paid $47.50 per share and paid a massive premium, around 40%, in order to acquire Hilton Hotels. The enterprise value over EBITDA multiple was 14% higher than the average of 4 comparable companies in 2007 at 15.7. The premium, paired with the market crash in 2008, led to a suspicion that Blackstone might have got into one of the worst deals of the century.
Blackstone faced detrimental headwinds a year after investing into Hilton Hotels as the financial crisis materialized. They were able to navigate these headwinds by restructuring the business and improving operational efficiencies that overall increased the margin profile of the business. Blackstone provided assistance with organic growth and international expansion, which played a pivotal role within the success of Hilton Hotels. Their initial investment of $5.7 billion was a large enough portion of their fund that they needed Hilton to perform well, so they focused on the investment more. Blackstone, however, had a unique exit strategy as they had 4 different exit points, making a cash-on-cash multiple and IRR difficult to calculate. However, exit 1, 2, and 3 were all shares sold to the public markets. In 2016, Blackstone sold 25% of its position to the Chinese conglomerate HNA. They maintained a minor position throughout 2018, which then they later liquidated. It was difficult to find information on the exit amounts in 2017 and 18, which may overall deflate the calculated cash-on-cash multiple and the IRR. However, it is important to note that the 2.48x cash-on-cash return is a phenomenal return based on the magnitude of the deal, as they drove over $9 billion of profit to their limited partners, making it one of the best real estate investments in private equity of all time.